All right, well, that's basically what's coming up with stocks in just a bit. Suresh Tantia is Chief Investment Officer, Strategist at UBS Wealth Management, South Asia, Pacific, Singapore. Suresh, good to have you with us here. Thanks very much. This morning it's not looking all that great as we've been describing the picture. US markets are down, yields are up, dollar is up. One of the largest banks here, HDFC Bank Group, numbers don't look all that great. So given all of that, we'll see a bit of a cut. But just to begin slightly more top-down, since we're speaking with you after a while, as we begin 24, Suresh, one thing is clear, and we got so much commentary from international speakers, etc., from our Davos coverage. Interest in India is right there. And for good reason, because there's earnings growth, which is kind of hard to find in a large liquid market like what we have here. So just your own kind of take in terms of what you're telling clients about putting money into the market at these levels.
Absolutely. I think from a global investor perspective, there's a lot of interest in India. It still remains one of our favorite market within the global space. I think the story is very different because when the global economy is slowing down, India is still delivering GDP growth of 6.5% plus. Earnings are still going to be up double digit this year when the global earnings will be under pressure. So I think from a global investor perspective, they are looking for growth, continuity of policy, and that's what India offers right now. And there's always a premium for quality. I know the valuation for the Indian equity market is very expensive. Some of the investors have expressed that displeasure or disappointment, but they do want to own quality, and India offers that quality right now.
Suresh, hi, good morning, and great speaking to you today, especially at a time when things are a bit tricky in the market, right? Let's talk about valuations. While the headline numbers, the Nifty valuations may not be that expensive at about 19-20 times forward compared to historic averages, it's the mid-cap space that gets you a bit worried right now with the valuations trading at almost a 40% premium to its long period average. Would you churn out of mid-caps and into large caps just as we get into a tricky time in the market?
We do like specific stocks and themes within the mid-cap space, but definitely given the expensive valuation of mid-cap over large cap, we are maintaining a more of a neutral stance on the size of the market. So preference both of mid-cap and large cap. We are focusing more on specific themes. For example, looking at industrial names, which will benefit from Capex recovery that India is going through for the next few years, and also on the consumption side. So financials, despite the disappointing results yesterday, we still do like them because of the strong credit growth.
All right. Hi, Suresh. Morning. Nigel on this side. From the financial pack, you've mentioned in the past that you like private banks in comparison to the PSUs. Do you continue to maintain that stance? Point number one. And autos was a space as well that I recall that you all liked a bit, and that's played out quite well. How much of it is in the price?
On the banking side, we do like both private banks and PSU banks because I think both are looking interesting at this point of time. You want to own beta when the credit growth is around 15%, irrespective of whether it's a private bank or the PSU banks. And valuation for the banking sector in general look very interesting compared to the broader market. So no preference, I would say, between private banks or PSU bank. We like them both. Auto side has also done extremely well. So we are not sort of chasing those stocks at this level. The focus is more on multi-year growth story. And that's why I mentioned industrial names and financials.
All right, Suresh, we'll leave it there. Thank you very much for joining us. Quick conversation this morning, but it's always good to speak with you here on CNBC-TV18.